Dates overnight. Let's get some analysis with Chris Weston from IG over in Melbourne. Chris, good morning to you. We certainly woke up to some worse than expected figures out from that ADP report, didn't we? What did you make of them?
Yeah, that seemed to be the trigger, Kate. I mean, I have seen in a number of different articles suggesting that the FOMC was the trigger behind the sell-off, but if you look at the charts, you can clearly see the market and different risk assets started falling about 10:15, which would obviously coincide with the ADP number. So clearly that was the trigger that came through. I mean, we'd already been looking at the global growth picture during Asia with the Australian manufacturing numbers, which dropped to the lowest level since May 2009. They were down 8 points and a pretty terrible read there. We saw the Korean export numbers up 0.2% on the month, up 0.4% on the month, with Nobel expected to be up 2%. Obviously, they're seeing a bit of a leading indicator ahead of next week's Chinese trade balance and their export numbers. There could be a little bit downside risk to those numbers as well. So they're obviously in focus. I looked at the ISM manufacturing numbers in the US as well, just after the ADP numbers, and they were actually slightly better, to be honest. I mean, they did fall to 50.7. They're just above the consensus of the market. But if you actually look at the new orders component, very much the forward-looking indicator, last month it was a shocker. This month it actually increased and continued to push above that boom-bust level of 50. So I actually thought the ISM manufacturing was a slight positive, and I think we did see Dow futures, S&P futures have a bit of a rally on that, but that wasn't enough. We did see the market then subsequently about turn and fall into the FOMC minutes. So I think the global growth story is still a major concern. I think we got new news on that last night. You look at copper, that was smashed last night. If you look at Aussie dollar, it came off pretty hard, about 90 pips or so from the ADP number. And of course we've got US Treasuries, which are clearly the best gauge on the inflation forecast, currently at the lowest levels of the year now. And if you actually look at break-evens, which is the difference between the 5-year bond, the 5-year Treasury and Treasury inflation protected securities, or TIPS, that's predicting a 5-year inflation forecast in the bond market of about 2%, just around that forecast that the Fed need to have at 2% threshold. So some interesting inflation forecasts being predicted by the bond market at the moment. But I look at the Fed meeting, and I think there was actually something in there for the bulls and the bears, for the US dollar bulls and bears there, to be honest. I mean, I think we'd gone in expecting the Fed to acknowledge the weaker data that we've been seeing throughout March and parts of April. Didn't get any of that, to be honest. What we did get was them, as you mentioned in that earlier synopsis for your American guest, is the fact that they have now the flexibility to do what they like with asset purchases. So that's the new development. But I think the failure to really come out and talk about the downside to price stability was probably something that the bulls, the US dollar bulls, will be certainly pointing to at the moment. So a bit of flexibility, and I think the Fed now have opened up. If we do see a continued downtrend, then they will be able to look at increasing Fed purchases by about 25, even 50 billion a month further down the line.
Chris, one big central bank meeting out of the way, but the ECB will meet tonight. Do you think a rate cut is all but priced in?
I think it's largely priced in. I think you might see a modest amount of downside, but there's not. It's not as just black and white as that, Kate. I did say out of 70 economists, one's actually calling for 50 basis points. There would certainly be a decent downside move in the euro if we did see that, because the euro would then cement its position as a funding currency. The ECB could come out and surprise and actually cut its deposit rate to a negative situation, something that I see absolutely a very, very low probability of do that. That would be a major situation, and certainly the hawks on the ECB would be loath to do that at the moment, but that would create a massive move down in euro dollar, to be honest. But I think for me it's about the non-standard issues that the ECB can come out with and do. They've made subtle hints of that. Mario Draghi's been talking about the links between monetary policy and fiscal policy and some of these bits and pieces. So they could come out with a similar style thing to what the UK are doing with the funding for lending, trying to incentivise the banks to lend more. They could do bits with collateral, lower collateral requirements, and accept collateral from some of the smaller SME businesses, which would be obviously good for the economy longer term. So there are bits and pieces they can do on the non-standard thing, and I think that most of those would be euro positive. And I think as a currency trader, you've got to look at the euro dollar at the moment. Okay, the dollar has been under pressure because the market's premise about future asset purchase, the big about turn from the tapering off that we've been thinking about a month ago. But the euro is really, really interesting beast at the moment. The fact is that the IMF have been forecasting a current account surplus in the eurozone for this year. of about 3%. You compare that to the UK, the US and Canada, which are looking for a deficit of 2-3%. You always want to be leveraged to a country or a region that has a surplus, so that's been very interesting. The fact that Deutsche Bank have come out with this big capital raising is another euro positive because it addresses some of their balance sheet issues. It potentially lowers funding risks coming through there. Some of the other banks in Europe may look at doing that as well. And effectively, you know, it could give them a more stable platform to increase lending longer term. So there's some things to like about euro, and the inability for the euro to fall, even though we've had weak data, suggests the market sees very limited amounts of monetary policy that these guys can do, hence why we haven't seen such a big fall.
Yeah, Chris, back to commodities. You mentioned copper was smashed overnight, down about 4%. We saw falls as well in the oil price, gold, silver, iron ore, I think was fairly steady. How's that setting us up for today?
We've got an open pretty much in line with the SPI, to be honest, Kate, down about 25 points or so, nothing too flash. Banks obviously in focus. We're going to have a few people looking to position themselves ahead of Macquarie and Westpac's numbers tomorrow. We did see a little bit of slow signs that people are rolling out of ANZ and position themselves in Westpac yesterday, hoping for a bigger than 86-cent dividend. But I think material names, you mentioned there, did get the materials did get completely smashed last night, and you know, I don't think the ADRs are really suggesting that we are going to see a big fallout. I mean, BHP's ADR is down about 14 cents, Newcrest is about 20 cents, and obviously we're looking for that recent low of 15.89 or so. So I think that they're going to be in focus, but the ADRs certainly aren't suggesting a big fallout today. Of course, 11:45 we've got the Chinese HSBC PMI numbers. They are a revision of the numbers that we saw back on the 23rd at 50.5. Obviously, anything below contraction of below 50 would be probably seen as a bit more of a bearish step there, considering as they look at the smaller businesses. So I think, you know, the oil names are doing pretty badly. I mean, the inventory levels that we saw coming through in Cushing yesterday, up 6.7 million barrels, highest levels again since in 82 years. Not going to be good for good news for the energy sector today. So yeah, it's hard to see where you're going to get any major strength coming through. Perhaps a little bit of a dip in some of the banks on open, maybe a buying opportunity for some.
Okay, Chris Weston, thanks so much.
Thanks, Kate.